Great Depression of USA, post-1929 crash, from Financial Diaries. The Great Depression was the worst economic downturn in the history of the industrialized world, lasting from 1929 to 1939. It began after the stock market crash of October 19, 1929, which sent Wall Street into a panic mode and wiped out millions of investors. Over the next several years, consumer spending and investment dropped, causing steep declines in industrial output and employment as failing companies laid off workers. By 1933, when the Great Depression reached its lowest point, some 15 million Americans were unemployed and nearly half the country's banks had failed. Throughout the 1920s, the U.S. economy expanded rapidly, and the nation's total wealth more than doubled between 1920 and 1929, a period dubbed the Roaring Twenties. In the mid-1920s, U.S. interest rates were kept low. From 1928, the Federal Reserve began raising interest rates, partly concerned about booming share prices. Increasing interest rates to 6% played a factor in reducing economic growth and reducing demand for shares. The stock market, centered at the New York Stock Exchange on Wall Street in New York City, was the scene of reckless speculation, where everyone from millionaire tycoons to cooks and janitors poured their savings into stocks. As a result, the stock market underwent rapid expansion, reaching its peak in August 19, 1929. By then, production had already declined and unemployment had risen, leaving stock prices much higher than their actual value. Additionally, wages at that time were low, consumer debt was proliferating, the agricultural sector of the economy was struggling due to drought and falling food prices, and banks had an excess of large loans that could not be liquidated. The American economy entered a mild recession during the summer of 1929, as consumer spending slowed and unsold goods began to pile up, which in turn slowed factory production. In the first half of the 1920s, companies experienced a great deal of success in exporting to Europe, which was rebuilding from World War I. Unemployment was low, and automobiles spread across the country, creating jobs and efficiencies for the economy. In the 1920s, investing in the stock market became somewhat of a national pastime for those who could afford it and even those who could not. The latter borrowed from stockbrokers to finance their investments. Until the peak in 1929, stock prices went up by nearly 10 times. The economic growth created an environment in which speculating in stocks became almost a hobby, with the general population wanting a piece of the market. People were not buying stocks on fundamentals, they were buying in anticipation of rising share prices. Rising share prices brought more people into the markets, convinced that it was easy money. In mid-1929, the economy stumbled due to excess production in many industries, creating an oversupply. Essentially, companies could acquire money cheaply due to high share prices and invest in their own production with the requisite optimism. This overproduction eventually led to oversupply in many areas of the market, such as farm crops, steel, and iron. Companies were forced to dump their products at a loss, and share prices began to falter. With Europe recovering from the World War I, and production increasing, the oversupply of agricultural goods meant American farmers lost a key market to sell their goods. The result was a series of legislative measures by the U.S. Congress to increase tariffs on imports from Europe. However, the tariffs expanded beyond agricultural goods, and many nations also added tariffs to their imports from the United States and other countries. The overproduction, oversupply, and higher prices due to tariffs had devastating consequences for international trade. From 1929 to 1934, global trade plummeted by 66%. Margin trading can lead to significant gains in bull markets, or rising markets, since the borrowed funds allow investors to buy more stock than they could otherwise afford by using only cash. As a result, when stock prices rise, the gains are magnified by the leverage or borrowed funds. However, when markets are falling, the losses in the stock positions are also magnified. If a portfolio loses value too rapidly, the broker will issue a margin call, which is a notice to deposit more money to cover the decline in the portfolio's value. If the funds are not deposited, the broker is forced to liquidate the portfolio. When the market crashed in 1929, banks issued margin calls. Due to the massive number of shares bought on margin by the general public and the lack of cash on the sidelines, entire portfolios were liquidated. As a result, the stock market spiraled downwards. Many investors were wiped out. Many Americans began withdrawing their cash from banks, while the banks, which made too many bad loans, were left with significant losses. On October 24, 1929, as nervous investors began selling overpriced shares en masse, the stock market crash that some had feared happened at last. A record 12.9 million shares were traded that day, known as Black Thursday. 5 days later, on October 29 or Black Tuesday, some 16 million shares were traded after another wave of panic swept Wall Street. Millions of shares ended up worthless, and those investors who had bought stocks on margin, or with borrowed money, were wiped out completely. As consumer confidence vanished in the wake of the stock market crash, the downturn in spending and investment led factories and other businesses to slow down production and begin firing their workers. For those who were lucky enough to remain employed, wages fell, and buying power decreased. Many Americans forced to buy on credit fell into debt, and the number of foreclosures and repossessions climbed steadily. The global adherence to the gold standard, which joined countries around the world in a fixed currency exchange, helped spread economic woes from the United States throughout the world, especially Europe. By 1930, 4 million Americans looking for work could not find it. That number had risen to 6 million in 1931. Meanwhile, the country's industrial production had dropped by half. Farmers couldn't afford to harvest their crops, and were forced to leave them rotting in the fields while people elsewhere starved. In 1930, severe droughts in the southern plains brought high winds and dust from Texas to other states, killing people, livestock, and crops. This dust bowl inspired a mass migration of people from farmland to cities in search of work. By early 1933, thousands of banks had closed their doors. In the face of this dire situation, the administration tried supporting failing banks and other institutions with government loans. The idea was that the banks in turn would loan to businesses, which would be able to hire back the employees. In 1932, with the country mired in the depths of the Great Depression and some 15 million people were unemployed, Democrat Franklin D. Roosevelt won an overwhelming victory in the presidential election. Roosevelt took immediate action to address the country's economic woes, first announcing a 4-day bank holiday during which all banks would close so that Congress could pass reform legislation and reopen those banks determined to be sound. During Roosevelt's first 100 days in office, his administration passed legislation that aimed to stabilize industrial and agricultural production, create jobs, and stimulate recovery. In addition, Roosevelt sought to reform the financial system, creating the Federal Deposit Insurance Corporation, FDIC, to protect depositors' accounts and the Securities and Exchange Commission to regulate the stock market and prevent abuses of the kind that led to the 1929 crash. Among the programs and institutions of the New Deal that aided in recovery from the Great Depression was the Works Progress Administration, WPA, a permanent jobs program that employed 8.5 million people from 1935 to 1943. In 1935, Congress passed the Social Security Act, which for the first time provided Americans security with unemployment, disability, and pensions for old age. After showing early signs of recovery beginning in the spring of 1933, the economy continued to improve throughout the next 3 years, during which GDP grew at an average rate of 9% per year. Depression-era hardships had fueled the rise of extremist political movements in various European countries, most notably that of Adolf Hitler's Nazi regime in Germany. German aggression led war to break out in Europe in 1939, and the WPA turned its attention to strengthening the military infrastructure of the United States, even as the country maintained its neutrality. One-fifth of all Americans receiving federal relief during the Great Depression were black, most in the rural South. But farm and domestic work, two major sectors in which blacks were employed, were not included in the 1935 Social Security Act, meaning there was no safety net in times of uncertainty. Rather than fire domestic help, private employers could simply pay them less without legal repercussions. And those relief programs for which blacks were eligible on paper were rife with discrimination in practice, since all relief programs were administered locally. Despite these obstacles, Roosevelt's Black Cabinet ensured nearly every New Deal agency had a black advisor. The number of African Americans working in government tripled. There was one group of Americans who actually gained jobs during the Great Depression: women. From 1930 to 1940, the number of employed women in the United States rose 24% from 10.5 million to 13 million. Though they'd been steadily entering the workforce for decades, the financial pressures of the Great Depression drove women to seek employment in ever greater numbers as male breadwinners lost their jobs. The 22% decline in marriage rates between 1929 and 1939 also created an increase in single women in search of employment. Jobs available to women paid less, but were more stable during the banking crisis, nursing, teaching, and domestic work. They were supplanted by an increase in secretarial roles in Roosevelt's rapidly expanding government. With Roosevelt's decision to support Britain and France in the struggle against Germany and the other Axis powers, defense manufacturing geared up, producing more and more private sector jobs. The Japanese attack on Pearl Harbor in December 1941 led to America's entry into World War II, and the nation's factories went back in full production mode. This expanding industrial production, as well as widespread conscription beginning in 1942, reduced the unemployment rate to below its pre-Depression level. The Great Depression had ended at last, and the United States turned its attention to the global conflict of World War II. Thanks for watching, friends, and see you in the next video.